The Doc's new investment option.
Lead Bullion.
Buy your ammunition from the Doc today at sdbullion.com.
When the Doc first envisioned SD Bullion, it consisted of providing consumers a product line of natural and organic medicinal and food options. First came colloidal silver, then came organic GMO-free survival food. Now comes the Doc's most complete medicinal option, Nutrigold, organic, GMO-free, whole food vitamin line. Unlike products formulated using synthetic vitamins and minerals, which suffer from issues related to poor absorption, poor assimilation, non-compliance due to metallic medicinal aftertaste, and tend to produce side effects like nausea when taken on an empty stomach, the Doc's new multivitamin line uses 100% certified organic fruits, herbs, and vegetables. Presenting the Doc's vitamin line, Nutrigold, safe, natural, wholesome, with no metallic taste, and better utilized by the body. Available within the Doc's medicine cabinet. There's a new type of gold in town, Nutrigold. Get yours today, only at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Joining us once again is one of our favorite guest hosts on the show out of London, Alasdair Macleod. It's great to have you back, Alasdair. It's been a while.
That's my pleasure, John. Thanks.
Well, we always really enjoy your perspectives and your expertise on the market, particularly the fundamentals in gold and all the statistics related to that. It's always a pleasure listening to you opine in the gold market. So,
well, thank you.
It's great to have you back. It's quite an interesting week here, both in gold and silver, following the massive rally we saw last week. Moves up to begin the week again, follow-on buying on Monday, really in both gold and silver. And then we saw, it seems like the cartel capping a bit the second half of the week. They really seem to be capping about the 1320 to 1325 level in gold and the 22 level in silver. But interestingly, they weren't successful in inducing too much of a sell-off off of those levels. Gold closing the week here on Friday, just around the highs for the entire week. The same thing with silver, maybe about a dime or 15 cents off the highs for the week at 22. So I guess start with you here, Eric, and pretty much exactly what we were looking for last week.
Yeah, indeed. We talked about how on Monday we'd probably see an Asian upside spike, and that we saw. And then I mentioned on Friday that despite the fact that a lot of people looking at a traditional world of technical analysis jumping up and down saying, hey, gold's broken out. Silver is not far behind. We need to jump into the sector because it's about to make a momentum move. And I pointed out that historically that's actually the exact time that the cartel tends to come in and put pressure on the market because they totally understand the technical signals. You get a little bit of an upside spike on Monday, and then on Tuesday we saw the cartel come in and cap the market in the early London hours, and from that point forward through Wednesday, you could see the algorithm trading patterns clearly coming in and pushing the market down.
And Alasdair was really at the forefront of kind of exposing some of the stats over in London and the Bank of England with their gold statistics last summer when we talked to you, Alasdair. Why don't we talk about 2013 and the big picture in general and what the implications are for the gold market and what the gold market globally looks like after the massive demand we've seen over really the last 12 to 18 months.
Yeah, I think one of the phrases that I picked up from what Eric was saying was physical limitations. And one thing that happened last year was they tried to stop people buying gold. I mean, that was the whole point of the April smashdown. And it failed. And it failed because they hadn't realized that if you lower the price of something, putting aside trend chasing, if you lower the price of anything, you just increase the demand for it. And we saw in April and May record sales of coins in the United States. We saw demand in Asia really just going off the Richter scale. And but somebody had to supply it, and this was the whole point. Everybody was trying to tell us, everybody in the system was trying to tell us, oh, it's ETF sales, it's the liquidation of GLD. That is what's being bought over in India and Shanghai and so on and so forth. I mean, if you just do the numbers, there's no way there's enough gold coming out of ETFs to satisfy the enormous demand that we were seeing. And so the central banks had to be stepping up their sales and leasing operations in order to supply that gold. And they were committed to do it because they did not want the Western investors, to smell the rat that actually gold is in a bull market and this is completely manipulated. And the whole point of manipulating it is you've got to succeed. And they succeeded to an extent, but the cost is that they have sold an awful lot of gold. We saw, for example, I think Eric referred to the German situation, or I think, well, was it you, John? The fact of the matter is that Germany can't get a gold back. Why? I don't know whether it's because the Fed is sitting on it or because the Fed hasn't got it. But whichever way, there is a problem. We also saw various other central banks, and this one was absolutely typical. Finland, who don't have a lot of gold, from memory it's about 100 tons, something like that. They made an announcement as to where it was stored, and this was after quite a lot of pressure from various politicians in Finland, like the Freedom Party, and various journalists as well, some of whom I was in contact with. And at the same time, Sweden, the Swedish National Bank, also made a similar announcement about the disposition of their gold. But what did not become public in English is the head of communications for the Finnish central bank runs a blog on the central bank's website in Finnish. And in that blog, she said approximately half the bank's gold is invested. That was the word she used as it was translated to me from the Finnish. In other words, everything that they had in London, which was half the gold, was out on lease. And she also made another statement, as is common practice with all central banks. Now, this is fascinating because it is clear that what's been going on is that every central bank who could possibly be on side, if you like, in the anti-gold move was whipped in order to smash the price. Now, the reason they had to do this was also because of the mess of the Cyprus bail-in. And do not forget that in the wake of the Cyprus bail-in, anybody with any reasonable deposits in a Eurozone central bank was thinking about the security of those deposits, because it was quite clear that bail-in was the way forward. But it didn't stop just at cash. People started thinking, well, I've got a gold account with ABN AMRO or Rabobank. I wonder whether I should get my gold back and store it myself. That might be a good idea. And the result was that after the Cyprus debacle, but before they rigged the market downwards with those very, very large sales in April, both ABN AMRO and Rabobank, the two Dutch banks, major Dutch banks, suspended any supply of gold to gold account holders. In other words, they have run out of gold. It's as simple as that. So behind the scenes, and this was never, ever really made public, you could see that there was a run on gold supplies. So the central banks have had to continue to supply it. We now have a situation going into 2014 where I believe the central banks who are sitting there and so far have been persuaded by people like the Bank of England, look, why pay storage fees when we can lease your gold and make it work for you and produce a little bit of income? They're no longer buying that story, I believe. I think that their attention is now switching around and they're saying, now hold on a minute. What is actually going on? What is the security of our gold held at the Bank of England, the Fed, the Banque France, wherever it might be? We'd better make arrangements to make sure that we do actually have that gold. And I think that is the background to 2014. Now, the other thing, there is a lot of disinformation in 2013 about the true position. And a lot of this disinformation comes from the bullion banks, the analysts, if you like, the mainstream analysts, who are completely misrepresenting the true demand from the Chinese public sector. Sorry, by public sector, I mean the Chinese public. The great thing about China is that through the Shanghai Gold Exchange, which has a monopoly in terms of acting as a physical gold exchange in China, plus the import-export figures of Hong Kong, we can know pretty well exactly how much gold is being delivered into the Chinese public. And I can tell you that between the two, it was 2,800 tons last year, including about 50 tons of coins. Now, that is a very, very different figure from the one that was put out, for example, by the World Gold Council this last week and by the China Gold Association, both of whom were claiming it was under 1,100 tons.
Yeah.
Now, the situation is even more stark than that, because for it to stop there, you have to believe that the government itself has not been buying gold in foreign markets and has only restricted its activities to buying gold on the Shanghai Gold Exchange. Sorry, don't believe it. The other thing which is very important is to understand the position of the mines. China is the largest gold mining nation in the world now, and last year she produced roughly 430 tons. Now, these mines are controlled by the government. The rules say that all mined gold has to be sold through the Shanghai Gold Exchange. But do you really believe that a government which controls the mines is actually going to put through the gold supply to the Shanghai Gold Exchange in order to buy it back themselves? I'm sorry, I don't go with that one at all. Governments do not behave like that. Now, if you accept that supposition, then we are taking 430 tons out of the global mine supply. We have got 2,800 tons of demand that we can actually identify with the Chinese public. And that leaves a global deficiency between mine supply and public demand in China of a minimum of 2,400 tons. Sorry, a minimum, what we've got is 2,400 tons to supply that 2,800 tons that we can identify. On top of that, it is quite possible, indeed I would argue it's very likely, that the Chinese government itself has been buying gold when the dips have given it the opportunity in London. There could well be some very wealthy Chinese who buy gold in London direct without going through any rules or whatever, and storing it abroad or even flying it back into China. I don't know. But the point I'm trying to make is that 2,800 tons is a minimum figure, and it probably, you should probably add on top of that, for true demand, all the Chinese production. And that explains why the West had to turn round and put a placeman into the Reserve Bank of India in order to ensure that India stopped importing gold, because otherwise the system was going to break very, very quickly. That is that the new governor, who was appointed in the middle of the year, was actually an IMF placeman. And you can go and look at his CV and all the rest of it, and you will see that he is just the same as all the other central bankers. And the other thing you ought to also know is that ex-colonial central banks, if I can sort of put them, without offending them, put them into that category, tend to turn to the Bank of England for advice on matters of foreign exchange, etc. And I'm sure that is also the case with gold. So the idea, the appointment, I think, was quite clearly in order to stop, to somehow extinguish the demand for gold in India. So that has happened, but it has opened the way for the Chinese, and the Chinese, I can tell you, have taken up more than the slack. So we now enter 2014, where the whole situation has turned around. We have had a major redistribution, not just out of GLD, but also out of the central banking community into Asia. And the result is that we really have almost no gold left in the West at all. And that is the background to 2014. And I think I was very interested in what Eric was saying from a point of view of, if you like, the sort of the short-term market feel he gets. But I think that background perhaps helps explain the situation which he has just been describing.
So, Alasdair, with the IMF having to put someone into India in order to stifle Indian gold demand with just the massive Chinese, and we're not even discussing Russian demand, which has been substantial as well. Where does that put the gold market here in 2014 should Narendra Modi be elected, who is the front runner in national election polls in India, who has publicly stated that rather than stifling the gold industry as the current officials, he wants to develop it?
Well, you're asking me to forecast what a politician is going to say tomorrow, and to assume that there is some truth in what he says today. I think the answer, quite simply, is that whoever gets elected in India, the BIS, the Bank of International Settlements, will through its connections into the central bank, ensure as much as possible that the restrictions on Indian imports are not lifted. That's the first thing I would say. You referred to Russian gold. It is interesting. The Russians buy some of their gold. I have been talking to the refining industry, and they tell me that they do come across Russian bars. So, in other words, not all the Russian gold stays in Russia. A reasonable amount of it comes out of Russia, one way or the other. So that is not such a fast and loose situation as the Chinese gold. And I can tell you that the refining industry never, ever sees Chinese refined bars in the market as a whole. They just don't seem to exist. In other words, it's all in China and it ain't coming out.
Yeah, and reflecting on the whole scenario with China's accumulation in 2013 and the back of the napkin numbers I've run, I see them as having most likely attained at least 7,000 metric tons stored. That's only 1,200 away from what the United States claims to have. And China's goal has been first to match the United States, then to reach 10,000 metric tons by 2020, and they will easily attain that probably in a year and a half or so. There are others who speculate that they have a much larger supply than even these lofty numbers that I'm speculating at. But it's beginning to be understood by the financial community worldwide that China has been doing this all along, and that at the same time the available Western supplies of gold, combined with the fact that we'll probably actually see a mine supply reduction this coming year because of the lower prices throughout last year, with a lag impacting the mining companies. I mean, we have seen all the reports from the Barracks and Gold Corps and other companies of the world for their fourth quarter, and they're pretty dour. They are speaking to lower reserves and curtailment of mine production because they just don't want to produce at these levels because they'd lose money on a cash flow basis in particular. And to top it all off, we are beginning to see a shift in expectations about this whole scenario with tapering. We're still in the minority, myself included. I mean, since November or so, I've been saying that the Fed would halt tapering in March, that it would be about $55 billion, and all of a sudden there are a lot more people saying the same thing. And simultaneous to that, expectations that the economy will roll over such to the point, even globally, that tapering will either have to return, or we'd have, as I expect to see, a introduction of the removal of payment of interest on reserves held at the Federal Reserve, and in an attempt to speed up the velocity of money in the United States and thereafter worldwide. We can see the turmoil that's going on in the emerging markets as kind of a leading indicator to what happens when tapering begins to shrink the global liquidity supply. And on top of all of this, we even see indications of an inflation expectation trade creeping back into the markets precisely because of an expectation that tapering as an ongoing process will be stopped. I mean, you only have to look at what's going on with the broadly based commodity sector to see this. Shares of the Power Shares DB Multi-Sector Commodity Trust Agricultural Fund have exploded. They've gone berserk. They're at like 85% relative strength index and have made a move off of like about $24 or so a month ago to almost $27 today. You look at copper, or, well, not so much copper, but certainly cotton, sugar, coffee, wheat, corn, everything. It's all beginning to just burst higher in the last month or so on the back of a very significant shift in market perceptions across the board about where inflation is going to be in 8 months, and it's pricing in the probability of this halt of tapering in the June time frame, give or take, which is what my expectation has been, and how this all intersects with the gold market and the silver market being of constrained supply. So we're seeing gold and silver respond both to these dynamics of a rise in inflation trade and the complete blowout that we saw of a short-term bear market trend in 2013, and all of this is pointing to higher prices in gold and silver going forward. So I think it's pretty constructive for investors in our space.
Yeah, there's something I think worth mentioning, and obviously the high net worth individuals that we would normally deal with tend to be managed by investment managers, family offices, and so on and so forth. In other words, professional investment managers. Now, you could take the view that that sort of money is controlled because modern portfolio theory doesn't actually have any room for gold as an investment. It sort of reckons that the risk-free investment is cash, followed very closely by short-term government bonds. I think the three of us know that that's absolute rubbish, and actually the least risky investment, because it is nobody else's liability, is gold itself. Now, the days when you could argue that central banks, investment regulators, and governments could control where investment flows went, I'm afraid those are gone. For one very simple reason, and that is that throughout Asia there is a whole new class of very wealthy people. And in terms of the amount of money they control and their numbers, I mean, it has really exploded since the Lehman crisis. And that means that that money could well start driving prices of commodities or money like gold and others, irrespective of what the investment management industry really believes is likely to happen, and that is that if inflation comes up, then you've got to sort of somehow protect yourself by index linked or something, or property or whatever it might be. No, I mean the situation is fundamentally changing with all the wealth in the East, and it's not going to behave in the predictable way which it has perhaps in the past. And I think we've got to factor that in as well.
This the year in 2014 that the physical constraints finally force the bullion banks and the cartel to take their foot off the accelerator and take a step back from the market and allow a little bit of the fundamentals to come back into play?
Well, I think it's got to because as I intimated earlier, I think we've got to the situation where the amount of gold held by the central banks, in other words, ultimately their control over the market, has diminished substantially. And I think, as well as that, I think that the supporters, if you like, of the cabal at the top table in the Bank of International Settlements, the supporters in the sense of all the smaller central banks, I think that they're beginning to question this idea of leasing their gold out. And I think 2014 is going to make it immensely difficult for the Fed and the Bank of England to control the bullion market. I don't think they're going to have the tools at their disposal in the way they did in 2013. They're tools that have been used up. I think it's as simple as that.
Yeah, it'll still be a managed retreat, though, because it just analogous to a bullion bank managing its own book. They can move in and out and suppress around the edges such that we don't see a massive short covering spike and then organic demand spiking thereafter. Their interests are definitely to just make this a somewhat managed price retreat, prices moving higher so that expectations of damage within the financial system don't run higher as gold's traditional role as a smoke alarm is muted. That's still very high on their objective list. And Turd Ferguson has been pointing out frequently about how J.P. Morgan, and also I should say Ted Butler as well, pointing out how J.P. Morgan basically has a corner on silver. I mean, if they wanted to be able to benefit enormously financially, they could just let the price run at free and they'd make a ton of money given how much silver they control. I think they have like 60% of the COMEX position. So, even though they are in a position to benefit extraordinarily from rising prices, the lead gold bullion bank at this point that is a handmaiden to the central bank's interests is even noticeably, demonstratably stepping back and still participating in the management of the markets, even though it would be at least indirectly in their financial interests when it comes to silver. But their larger financial position, their interests overall, are the continuation of the fiat money financial edifice that we have built over this time, with ever increasing financialization and paper pushing of our global financial system. And and J.P. Morgan is one of the kingpins that benefit from that. So,
I think, Eric, I think I'm going to disagree with you a little bit on the managed retreat, because a managed retreat assumes that someone is in a position to manage the retreat. I don't think that's quite true now. I think they've lost that facility. I think they've lost that ability in 2013. And I think it's a very, very important point. Sorry?
To be more clear, I don't mean in the long term. They have lost the ability in the long term. There's no doubt about that. In the short term, however, just as we saw Tuesday morning in London and through Wednesday in particular this week, even though we were set to continue with momentum movement higher, we saw the prices come down, and they came down in a fashion that was suggestive of the sharp spike and running of the stops on Tuesday in particular, which are the traditional footprints that we see of the cartel when they perform short-term actions of trying to contain sentiment. By all means, I totally agree with the thesis that you're presenting about 2014 overall. The bullion banks and the central banks, and the Western central banks, to be more clear, do not have the ability to keep this market down, and they're just doing a managed retreat, and that speaks to short-term actions, not long-term.
Yeah.
I think we're all pretty much in agreement that 2014 is shaping up to be potentially the year where fundamentals finally kick back in, and we see a major resumption of the secular bull, and we're really just starting to see a little bit of movement to the upside. But if we recall 2010 and late 2010, 2011, things can move pretty fast when you not only have the fundamental buyers and the Asians, but then you also have the hedge funds and all the momentum traders piling on to the upside as well. So we're a long way from that right now, but certainly wouldn't surprise me to see that type of buying again in the next 6 to 12 months materialize at some point. So,
yeah, I think also the monetary background, I think, is very important in this. We were talking earlier on about tapering and all the rest of it, but actually we've also got to bear in mind that China is a very, very big elephant in the room. They have expanded bank credit by, I think, from about $10 trillion equivalent to $25 trillion equivalent today, between the Lehman crisis and today. Now, on top of that, they've got a shadow banking system, which has just gone completely out of control. And friends of mine who've come back from China talking to government officials and ordinary people see that there is a determination at the government level to try and bring this under some sort of control. But meanwhile, everybody is partying like, the money's still there, it's still free, still get it, and so on and so forth. So there is actually, I think, potentially quite a nasty accident waiting to happen in China. And the other thing is that the overall expansion of the quantity of money, all of which at the end of the day is based on the dollar, because the dollar is the reserve currency. We're now looking at a situation where you've not only got about the equivalent of about, say, 12 trillion of US M3, you've got another, I calculate, in the next 50 currencies in terms of size, a further $67 trillion equivalent. You've then got the shadow banking system, which I guess today is around about 75 trillion. So if you add all that up together and compare it to today's monetary base of just under 5 trillion, you're geared about 40 times. That's quite worrying. Even worse, if you remember that the reason that we've had the expansion of the monetary base in the States was as an indirect, or sorry, rather direct result of trying to rescue the financial system in the wake of the Lehman crisis. So if you go back to the 2008 balance sheet, mid-year, you're looking at a monetary base of less than $1 billion, and the gearing goes up to over 150 times. That is the amount of fiat currency on that dollar base. So I'm just sort of trying to bring it all back and show you the amount of gearing there is in the system, and any idea that there is an inherent stability returning. I'm sorry, it's not. It's actually extremely dangerous, and it's become more dangerous. So if you get the two major economies, America and China, beginning to try and rein in the rate at which money is produced, whether it's bank credit or whether it's narrow money through tapering, is immaterial. But if they're trying to rein in and, in effect, take the rug out of, carry trades, cross-border investment, and that starts reversing, then we have got a real problem. And I think it's amazing that the Fed either doesn't recognize that or is keeping extremely quiet about that aspect of life, because it is probably the most important factor in any decision they take about tapering.
They're probably aware of it, but they realize that they're stuck and they're scared. Not much they can do.
You're absolutely right. I mean, I think they're rather like a rabbit frozen in the headlights of an oncoming car. They just don't know which way to go. They've got themselves into this position, and they, I think, feel that they've got to try and work out an exit. But the exit is completely incompatible with interest rate policy. I mean, the idea that you can sort of you reduce the flow of money into the system and keep interest rates down at zero, it's completely inconsistent. That's not life. The reason that interest rates are at zero is because there is an unlimited supply of money ensuring that they remain at zero. So, there are all sorts of inconsistencies in their position. And it does seem to me, as you rightly point out, Eric, that we've got a situation where, the central bankers just don't know how to get out of the problems they have created for themselves.
It's more like they're playing a game of poker with the markets and trying to keep a poker face by hoping to fool everybody. I mean, last December's tick report showed that the Belgians were the largest purchasers of the treasuries, and the Chinese had the largest sale of treasuries in more than a year. And the Fed continues thus having to be the buyer of last resort of 5-year, 10-year bonds on our market in order to maintain this status quo of interest rates on the 10-year under 3%, for example, such that it doesn't crash our housing market. And all the while, our economy is beginning to roll over. The housing statistics are starting to stink. The unemployment reports have been terrible in the last couple of months. Everybody's on pins and needles. This is an election year, and so the incentives for political pressure on the Fed are also even higher. The Fed also wants to put out an image of it being responsible by curtailing its bloated balance sheet as basically the largest hedge fund in the world. And that's part of what's motivating their desire to taper. And I suspect that's part of my thesis to why, in the June time frame, in the very least, we'll hear guidance change, if not outright policy change, where they'll target the velocity of money by removing interest payments to banks who have on deposit reserves at the Federal Reserve, and then just stopping the curtailment of the bond buying, freezing tapering at $55 billion, so to speak. And that's what seems to be their best poker game face, but it doesn't look like that's going to be sufficient to keep all of the gum and baling wire together on the wheels of this cart. It's just really unstable, and it won't take that much for some kind of accident to happen. And that's probably what we're looking at in the second half of 2014.
It's looking like it. I must say. I can't come up with a more positive analysis, really, I'm afraid.
Well, Alasdair, always a pleasure to have you back. Really appreciate taking the time. One of our favorite guests here on the show.
Well, thank you, John. That's very kind. It's very much my pleasure being with you and Eric.
Okay, so look for big things potentially in the gold market here in 2014 as the cartel is no longer able to manage the retreat over the long term the next couple of years here due to the restrictions on supply of physical metal. So we'll wrap things up there for this week. For the Doc and Eric Dubin and special guest host from London, Alasdair Macleod. Thanks for tuning in to the SD Weekly Metals and Markets.
The Doc's new investment option.
Lead bullion.
Buy your ammunition from the Doc today at sdbullion.com.